Now we turn to Europe, the ECB, what's happening, and there's some positive news, there's some negative news, and it's kind of a mixed bag, especially because we have some of the some recent updates. So just to kind of touch on some recent things when we're looking at PMI. So France essentially beat across the board, which is a positive. You know, France manufacturing was supposed to be at 50.1, came in at 51.1. Service PMI was supposed to be at 40, came in at 49.2, which puts the composite at 49.6, which, again, it's contractionary, but as we've said, between 48 and 52, you're kind of within this comfort where things are just kind of holding firm. Now, on the German level, German manufacturing was expected at 56.5, came in at 58.6. Service was supposed to be 44, came in at 47.7, putting the composite at 52.5, which, again, we're getting back to some of this comfort. And the benefit is this is happening in December. So this is December flash, which if you look at some of the issues that we've seen in terms of COVID and slowdowns in the economy, we're starting to see some of this normalcy on the manufacturing side. Now, the problem overall is the slowdown in exports, which this is good internally, but how are we seeing this turn around? So then the market, Eurozone manufacturing was expected at 53, came in at 55.5. Services was supposed to be at 42, came in at 47.3, and putting the composite at 49.8. Again, all of these are positives. It's just a matter of, are we going to see this growth going forward as the unemployment remains an issue, but the ECB continues to ease and do things that they can to try to not only knock down the euro, but also try to support the underlying economy. And this is just kind of this picture is just giving you kind of what have they done. So the Pandemic Emergency Purchase Program increased 500 billion euro to a total of 1.85 trillion, lasting through March 2020. Reinvestments of the principal payments from the PEP purchases will run through 2023. ECB traditional QE program to bring inflation back to target to run at 20 billion a month. Again, open-ended, additional buying. Pandemic emergency longer-term financing will continue. Targeted long-term financing operations. Again, all of these things continue, and then obviously looser collateral rules. And we're already seeing a lot of these debt levels where, debt that's being issued at 0%. So it's either 0%, negative percent. And again, there's only so much that can be done as they try to continue to reinflate. But we continue to see pricing come down. But as we said last week, it's not ubiquitous. It's something where we're seeing some increases where people are spending money, prices are going up. Where people aren't spending money, prices are going down. So net, it looks like it's falling, but the actual pain to the person is increasing or prices are increasing as they're either had pay cuts, are unemployed, are seeing pressure. Again, these are things that are continuing to weigh overall. But what we're seeing right now is obviously things are still moving in a positive direction. Now, while it's still contractionary, it's still in a positive direction. It's just, can we see that leapfrog into January as we see Germany extending their lockdowns, UK going into another one, and then obviously we have the overarching concern of, well, what does the British exit look like? Is this just benefits from British exit where some people are looking to hoard, are looking to buy ahead of time to make sure that they have enough in inventory to make sure that they can bridge some gaps? There's some fluff in some of these numbers, but again, still net they are a positive. And now when we look at the ECB and what they've tried to do, you look at the US dollar versus the G10. So the latest data point, again, the dollar, as we look at the US dollar versus emerging markets, ex-China, you can see that we've had some strengthening overall as the dollar index to be 100, and you're starting to see some of this fall back down. But the problem is the strength of these currencies against the dollar is hurting the euro in general. And the ECB is looking to kind of normalize that, and they're trying to do different things in order to incentivize that, whether that be more borrowing, trying to inflate the economy overall by just buying outright. And they're starting to run out of things to buy, which is a bigger issue, especially as we look at the extension of the programs. When we look at the European Central Bank, ECB cumulative net purchases under current programs, you can see where we sit at about $3.7 trillion of purchases. And this is only accelerating. It's not stopping as we go through 2020 into 2021. But German COVID outbreaks was less severe. But this is what we've been talking about, where German COVID continues to outpace. Now it's even above France and Spain as the UK has stopped going down. And this is what is starting to see some of these commentary about, well, do we need to extend the lockdown? Do we need to extend some of these shutdowns to mitigate against some of these pressures, which is going to be the tailwind, the headwind to some of the tailwinds that we're seeing on just general economic activity. And here, when you look at mobility tracker and bank lending, mobility tracker started to recover. It's gotten a little bit better, as we've been talking about, in terms of just where it is right now. But lending to private sector still is a concern. It still hasn't normalized. And that's what they're trying to fix. They're trying to get banks to lend again. But with this uncertainty within the European Union in general, from British exit to COVID, we're seeing this unwillingness to really do much, even as mobility falling, lending rising, and now we're starting to see some of these pressures that they're looking to alleviate. But they're also running out of things to purchase. So when we look at change in mobility, retail and recreation, this is just looking at a place where France has gotten better. Their numbers have gotten better. They're still slow in terms of the lockdown ended. So we're picking up some of the benefits of a lockdown. We want to see, can their COVID cases remain low, or will we see another snapback in a lockdown? And now here you saw the quick kind of movement back to normalcy, but then it flatlines. And that's, even though the fall wasn't as aggressive, the snapback is going to be something a bit more measured, where we'll get to kind of this normalization of down, call it 15 to 20% versus pre-pandemic levels, as remains that concern overall. But when we look at Europe, what is Europe able to do? ECB net purchases are now higher than net supply. So that's why we continue to see the ECB just buying paper that they possibly can, not just new issue, but previous issues, in order to meet the number that they've been talking about and trying to stimulate the economy, which is, again, pushing rates negative, keeping rates negative, keeping pressure under, which is why Portugal, Greece are all yielding 0%. On a not on a gross level, not on a real level, it's negative. And these are things that we need to consider when we're looking at the health of Europe. And is this just another Band-Aid on just overarching problem, which continues to reverberate, where debt is exploding everywhere. It's trying to pull forward growth at the expense of the future. And this is just another example of now they've actually outpaced. So, European governments might just say, "Here, I'll sell you more debt. I'll borrow more against you at 0%. You're paying me to write a bond. Okay, sure, I'll do that." And this is where we continue to see this perpetual motion. And where does it stop? I don't know. How does it stop? I don't know. Because this is just pushing more and more people into equity. It's just inflating these numbers so that the valuations continue to go higher, multiples continue to trend up. And this is these bubbles that, they talk about reflation, but when you look at an equity and bond bubble, I mean, we're at massive levels that are only getting bigger. And now we're starting to see some other real cracks starting to form in emerging markets, India and some other areas, which we'll talk about in the next segment, which again is just going to be a bigger problem to just global economic growth and just general recovery into 2021.